All right, for more on today's data and the Fed impact, let's turn to Mark Zandi, chief economist at Moody's Analytics. Mark, great to have you with us. You've been in the no recession, soft landing sort of camp for some time. How does this change your calculus in terms of what you see the Fed doing, whether it be in terms of hikes, more hikes, and or cuts next year?
Well, Melissa, I think it just confirms that the rate hikes are over. I mean, I don't see any reason why the Fed would view this report any other way than, inflation's coming in and all the trend lines look really good. It was just an absolutely positive report. I don't think the bar is pretty high for them to actually cut rates. I think they need to be absolutely sure that inflation is going to get back to their target before they do that, and that Zandi's forecast is correct. So I don't think that happens quickly. That's probably not until mid next year. And then even after that, I think they cut rates slowly. But, a report like this does just cement, I think, that path that they're headed on. I think they should feel very good about the way things are going.
Hey, Mark, it's Tim. I was not joking, but there is some sense out there that people saying the Fed has had nothing to do with this, that this is really just working through COVID dynamics. I don't think that's really true. And when the government gives away 25% of GDP, reeling in both money supply, but, having some of that stuff run off, you get the impact we've had. Was there anything today in those numbers, though, in that core that structurally felt different about where we are in CPI that's Fed impacted?
Good point. I think most of the improvement in inflation goes to the fact that the pandemic and the effect of the Russian war on energy and commodity prices, that's now increasingly in the rearview mirror. And, as a result, that's why inflation's come in and why, the Fed hasn't had to raise rates more and why the economy is going to be able to avoid a recession. Having said that, they've had, the rate hikes have had an impact. The job growth is slowing, wage growth is moderating, and that is having an imprint on the inflation number. So, on the list of reasons why inflation is coming in, I wouldn't put the Fed at the top of the list, but it's definitely on the list and it's helping get inflation back into the bottle. And without those Fed rate hikes, I don't think we'd be where we are today. Looking at these reports, though, the thing that makes me feel particularly good is you saw new vehicle prices finally roll over. And I think that's the beginning of a trend here. We're going to see new vehicle prices come in as we get better production numbers coming in from Germany and Japan. We should see more inventory and weaker car prices. And then, of course, the key is the cost of housing services, as you pointed out, Tim, that is moving in the right direction. And I expect that to continue, over the next 6-12 months. So everything feels like it's to script, but I wouldn't give the Fed a lot of credit here, but they certainly deserve some credit.
So if they only deserve some credit, Mark, that implies that the full impact of the rate hikes have not yet been felt. So how do you think we will see them, and why do you think that won't tip us into a recession?
No, Melissa, I think we have seen the effects of the rate hikes. The job growth is slowing, the labor market's easing. Wage growth is moderating. The economy is, abstracting from that third quarter number, which was gangbusters for GDP. It does feel like the economy is kind of throttling back. Unemployment starting to move higher. So I do think we've seen a lot of the effects of the rate hikes already. We've got more to come, but I think they'll be modest and sufficient to get the economy where it needs to be to get inflation back in the bottle.
Mark, it's Karen. Thanks for being on. Let me just play devil's advocate for a minute. We have so many mortgage holders that have, very low rates, and those are starting to age. And they may be, if they're 2000 or 21 vintage, 25, they may start to really see those effects. And you usually shouldn't wait till the very end to roll over. So I think that does seem to be like a lot of current cash flow that mortgage borrowers have that they won't have 18 months down the road.
Well, I don't know, Karen. I mean, the bulk of the mortgages were made back in 2020, 2021, and those are 30-year or maybe 15-year fixed rate. So it's going to take a long time before, those homeowners see, rates adjust. And the only adjustment is if they move, and if they move, there's no problem there whatsoever. And here's the other thing. I mean, you look at total household debt, all liabilities, the whole shooting match, cards and consumer finance, mortgages, home equity, student loans. Only 10% of that debt adjusts within 1 year of a change in market rates. You're right. I mean, over time, the rate effects will be felt, but that's over a long period of time, and I don't think it's going to do a whole lot of damage.